Today we're going to dive into a topic that is incredibly important for anyone getting a mortgage. The topic is insurance.
Oh, this is a juicy topic, Neil. Whether you're a first time homebuyer or looking to refinance, understanding the types of insurance that are available to you is critical. Today, we're going to break down the key insurance options every mortgage client needs to consider and understand. There's a lot to cover, so let's dive in.
Good. So let's start with default insurance. Now, this is something that people often overlook or maybe even are simply confused about. If you do not have 20% down payment, it is mandatory. But there is a little more to it than that, right, Jerome?
Yes, Neil, for sure there is. Default insurance, also known as mortgage default insurance, or some people just refer to it as CMHC insurance, it's required by federal law in Canada when your down payment is less than 20% of the purchase price. So there's something about this type of insurance that is really important to know and remember, though. While you, the customer, pays for the insurance premium, that is, it's added to your mortgage, this insurance only protects the lender if you default on your mortgage. It doesn't protect you, the borrower.
Really? So, if a lender is protected, what happens to the borrower in the case of a default?
That's a good question. So, the insurance company will reimburse the lender for their loss, but they can still come after you, the borrower, to recover that money. You're essentially paying insurance premiums that benefit the lender, not you. It's important to understand this because many people assume that they're covered in case of default, but that's not how this program works.
That is a crucial distinction. You're paying the insurance for the lender's protection and not yours. However, it is this insurance that allows you to purchase a home with less than 20% of a down payment. So there is benefit to it. And additionally, there might be some reduction in the interest rates that is generally available to you with an insured mortgage.
Yes.
Let's move on to the next hot topic, creditor insurance and disability protection, which can sometimes be a bit confusing for clients.
Yes, another insurance product. First off, it is important to know that this creditor insurance and disability insurance are not mandatory. They're often offered by the mortgage brokerage or lender, usually through the lawyer's office when you're finalizing your mortgage.
So these are optional add-ons. What should the clients be aware of when considering them?
Well, one thing to be aware of is that while the premiums for these policies stay the same throughout the mortgage term, the payout amount decreases over time as your mortgage balance goes down. So that's one drawback. And it's not like traditional life insurance where the payout remains fixed. And there's something about underwriting process that's different from other insurance types, right?
Oh, yes, that's a key difference. Creditor and disability insurance often have something called as post-claim underwriting. This means the insurance company only fully assesses your eligibility after you make a claim. So they could potentially find a reason not to pay out, which can be a big concern for many clients. Unlike traditional life or disability insurance, where underwriting happens upfront, here you don't always know if you're fully covered until you need it.
Exactly.
Now let's talk about home insurance or fire insurance, as it is sometimes called. This one is mandatory, but there is more to it than just ticking a box for your lender, right?
That's correct. Home insurance is required on every mortgage because it protects both the borrower and the lender. If there's a fire or other major damage to the home, the insurance will cover the cost of the repairs or rebuilding if necessary. But here's where it gets a little bit interesting. If there is a low balance left on your mortgage when a claim is made, the lender gets paid out first. and the remainder goes to you so that way you can rebuild your home.
Which might not always be enough to rebuild fully, right?
Exactly. So the home insurance coverage is often based on the original purchase price or the replacement value at the time that you set up the policy. If the cost to rebuild has gone up like it has, we've seen this over the last bunch of years, or you've made significant improvements to the property, you might find that the payout isn't enough to cover everything. So it's a good idea to review your coverage regularly and make sure it's up to date with current home values.
That's an excellent point, Jerome. Now let's move on to life insurance. This one can be a little more flexible than creditor insurance, but there is still a lot to consider. What do clients need to know?
Life insurance is one of those things that's purely tied or tailored to your own personal situation. There are several types. There's term life, which is generally the simplest and most affordable. There is whole or universal life insurance, which offer more complex benefits. Term life insurance is great for covering specific needs like the mortgage balance, but whole or universal life can be used for long-term planning and even building some cash value over time.
And some people may already have life insurance through their employer. So, should they consider one while they're getting a mortgage?
That's true. Many employers offer life insurance through group policies. But here's the thing, it's often not enough, and more often simply tied to your income. And it may not cover you once you leave that employer. So what's important to review what coverage you have already and whether it meets your current and future needs.
So, what do you suggest? What is the best approach here?
The best approach is to sit down with a licensed insurance professional who can assess your current situation and help you decide whether a term policy or a more comprehensive whole or universal life policy makes sense. They can also make sure that any coverage you have fits into your overall strategy, whether you need something minimal or something more robust for some long-term planning.
This has been a ton of great information. For our listeners, we have put together a document summarizing all of these insurance types, which you can download from our websites.
That's right. You can find the link in the show notes or visit our websites for a complete breakdown of these options. It's important to protect your home and your family, so don't hesitate to reach out if you have any questions or need some advice.
Thanks for listening in to Getting Your Shit Together. Until next time, make sure your home and your future are protected. Hello, everyone. Welcome to the second half of Getting Your Shit Together. Today's topic may not be the happiest one, but it is still an important conversation: mortgages and divorce. Jerome, this is something that can really throw people for a loop, right?
Oh, absolutely, Neil. You know, divorce is tough enough on its own, but when you add the complexity of mortgage and financing into the mix, it can certainly add to the amount of stress that there is already there. The big question that a lot of people end up with is, what now? What happens to the mortgage? How do you split the responsibility? There are a lot of options, but it's important to know what you're facing so that way you can make informed decisions.
Yeah, it's not something that's often talked about until you're right in the middle of it. But if you're going through a separation or a divorce and own a home together, one has got to make some big decisions about their mortgage. So, what should be the main options people should consider, Jerome?
Well, for starters, there are three main routes that people eventually take. First is one might decide to keep the home. In that case, they would either assume the existing mortgage or do something called a refinance or a spousal buyout to remove the other person's name.
Okay.
Second is simply the house could be sold, and then the proceeds are split between both sides. Third, some couples decide to continue co-owning the property even after the divorce, usually for the sake of the kids or until the market conditions are a little bit better to sell.
Okay. So maybe we can do a deep dive and let's maybe get a bit more into the scenario where one spouse keeps the home. This is probably the most common situation we see, right?
Yeah, for sure. So the person who wants to keep the home will either need to assume the mortgage, the existing mortgage, or do what's called a spousal buyout, which is kind of like a refinance. The phrase could almost be interchanged, really. The goal here is to remove the exiting person from the mortgage and the title, which can be tricky depending on the finances of the individual that's going to stay in the home and assume that mortgage or, get the new mortgage.
Mhm.
They'll have to qualify for that mortgage on their own, which means that their income, credit, and debt levels are all factored in to whether or not they can carry the mortgage by themselves.
Yeah, and that's not always easy, especially if both incomes were needed to qualify for the original mortgage in the first place.
Yeah.
The spousal buyout is one option, but that can mean taking on a higher interest rate or extending the mortgage term, right?
Exactly. And don't forget, when you do this spousal buyout slash refinance, you're often pulling equity out of the home to pay the other spouse, which now adds to the new mortgage amount. So if the house is appreciated since its first purchase, you might have some room, which could be good, but you could also be looking at a much bigger loan than you had before because now you have to pay more out. But for some, it's worth it to keep the home and provide that stability, especially when there are kids involved.
And then there is the option to sell the home and split the proceeds. This can be more straightforward in most cases, but that doesn't mean it's without its challenges.
Well, that is so true. Selling the home means that you both walk away with whatever equity is left after paying off the mortgage and oftentimes the other debts that were included in the matrimonial scenario. The challenge here is just timing. Sometimes the market isn't favorable, and one spouse might not want to sell right away because they want to maximize the opportunity. But if you can agree to sell, this is often the cleanest way to split things financially and move forward. And then there is the third option where you continue to own the home after the divorce. Much less common, but it does happen.
And this is probably a temporary solution, like when both parties agree to keep the home for a few years or months for the sake of their kids, or they want to wait till the market improves before selling. But co owning post divorce can be too tricky, right? You still need to agree on mortgage payments, repairs, other expenses. So it requires solid communication cooperation. That can be a big ask after a divorce, right?
Yeah.
But but if it works, it could make sense for some couple. So Jerome, what would you say are the most important things to consider when dealing with a mortgage in a divorce?
The first thing I would say is that each individual must get clear on your own finances. Can you afford to keep the home on your own income? Or is it better to sell and start fresh? The second thing is timing. As we've talked about, it's best not to rush into any decisions just to get over with, but it's also understandable in some situations where that is the path to take. Third is key, which is work with a mortgage professional to figure out your options. Whether you're looking to refinance or do that spousal buyout, sell, or keep it and co own for a little while, we can certainly help you understand what's financially possible and what makes most sense for your individual situation.
Yeah, having the right advice makes a huge difference, and always. Divorce is emotional, but when it comes to your home and the mortgage, it's helpful to be practical. What are some common mistakes you see people make in these situations?
This is a good one because one of the biggest mistakes that I've seen is one party assuming that they can handle the mortgage on their own without running the numbers first.
Mm.
Um, and it's important, like we've said, to be realistic about what your income is and your expenses, especially if you're now living on only one income instead of the previous two. So another mistake is not considering the costs of refinancing or selling, like things like legal fees, penalties for breaking the existing mortgage, realtor fees if you decide to sell. All of these costs can add up. So it's important to know what you're getting into.
Plus, we're assuming that the property values are in line, right? The property is not under the water.
Yeah, yeah,
Well, great points. As mortgage professionals, we will provide you with a detailed list of anticipated costs ahead of time so you know what to expect. A lot of people forget that there is no one size fits solution. It really depends on your individual situation, your financial standing, and what's more important to you, whether that's keeping the home, selling, or finding a new living arrangement altogether.
exactly, Neil. The goal is to make the best decision for your long term financial health, not just get through the divorce process, although that may be a factor for some. Um, but working with a mortgage broker can really help you navigate your way through the options and avoid making decisions that really could hurt you down the road.
I think that's a good place to leave it. If you're going through or about to go through a divorce or separation and aren't sure as to what to do with your mortgage, reach out to either of us. We are here to help you figure out the best path forward, whether that means refinancing, selling, or finding another solution altogether.
Absolutely. And divorce is never easy, but making some smart financial decisions now can save you a lot of stress and heartache later, or further heartache. Thanks for tuning in, everyone. If you have questions, don't hesitate to reach out. We're always here to help and help you get your financial shit together.
And don't forget to subscribe and share this episode. Until next time, take care of yourself and your finances.